So, sorry, I think you can start now. Hope you can all hear me, please.
Yes,
Yes,
sir.
sir.
All right, please, I'm very sorry for this,
Yes, sir.
all this lateness. So, tonight we'll be looking at IAS 23. So, IAS 23 is the accounting standard that tells us how to treat our borrowing costs, what we should capitalize, when should we capitalize, and when should we stop capitalizing our borrowing costs. And also it tells us more about the meaning of qualifying capital expenditure. Sorry, please. Please, can you confirm if you can see my screen?
No, sir.
No, we can't see it, sir.
No, sir.
Okay, 1 minute. I don't know why the MTN is doing us like this tonight. Let me close the file and open it again. Can you see it now?
Not yet.
Yes.
Yes, sir.
Yes, sir.
Yeah. It's
You can
working
see it
now.
now. Okay, okay. Perfect. We have wasted most of our time already, so let's just be very fast to it. It's 23. So I welcome you all once again. Let me mute everyone so that we will not be distracted. Anytime you have a question, you can just use the emoji to let me know, or possibly drop it in the chat box. So I'm going to call you and you can ask. Let me just mute everyone so that. All right. So good evening once again. Tonight we'll be looking at IAS 23 borrowing costs and what entail this accounting standard. Tell us more about what should we capitalize as borrowing cost, when should we capitalize, and where should we stop capitalizing, and also tell us more about the meaning of qualifying assets. So let's start with some definition of some keywords. We have the borrowing cost itself, we have qualifying assets, also we have capitalization of borrowing cost. What do you mean by borrowing cost? Borrowing cost, this simply means an interest or other cost incurred by an entity in connection with a fund that they borrowed for a particular project. So borrowing cost simply means the additional expenses, the additional interest on the fund that a company or an organization borrowed to embark on a particular project. So it simply means interest, yes, or the finance cost incurred on a particular fund used for a project. So what do you mean by qualifying assets? When we say qualifying assets, these are the type of assets that take a substantial time or a substantial period before they can be ready for their intended use. So these are the assets that take us a substantial time, a lengthy period of time before we can complete their production or before we can complete their their production or their manufacturing, the manufacturing process. So it's going to take us a substantial time before we can complete it, and also before it can be ready for the intended use. Also, we have capitalization of borrowing costs. What do they mean by capitalization of borrowing costs? I think last week someone asked me about this capitalization stuff. So when we say capitalization of borrowing costs, this simply means the recognition of interest and other related costs of borrowing as part of cost of an asset rather than an expense in the statement of profit or loss. Let me break it down. When we say capitalization of borrowing costs, what we simply means here is that the process of adding those extra costs, we are going to add the extra cost incurred on the particular fund, the extra cost, which is the finance cost. We are going to add that finance cost back to the actual fund. We are going to add it together for us to determine the value of the particular asset that we use that particular fund to build. So there are two ways: we can expense it or we can capitalize it. When we expense it, means that we are going to treat it as normal expense under our profit or loss account. But when we capitalize it, it means that we are going to add that value to the actual cost of the asset. That value will be part of what we are going to call the value of our assets. Let's say, for example, maybe we borrow another APS tutorial now, borrow an 100 million fund from UBA, and we had to incur a finance cost of 100,000, or let me say a finance cost of 1 million, and we borrow 100 million to finance a particular project, and we are going to incur a finance cost of 1 million. Now, when we expense it, it means that the value of the asset is still going to be the 100 million, while the 1 million finance cost will be treated as normal expense under our profit or loss account. But when we are talking about capitalization of borrowing costs, it means that the value of that particular asset will not be 100 million again. We are going to call the value of that particular asset 101 million naira. We are going to add that finance cost to the actual fund that we borrow in determining the actual cost of the assets. So I hope I'm clear a bit on this. So let's move forward. Or do you have any question on this? Okay, that's already. Please, you can ask your question, Mrs. Dayat. Can you hear me? Okay, I think this does not have any question. So let's move on. So what are the examples of borrowing costs? Example of borrowing costs include interest expense on non-convertible loan calculated using the effective rate method of IFRS 9 finance instrument. Is also a standard that we'll be looking at. So we also have another example: interest expense on debt component of a convertible loan. We also have another one: interest charge in a lease contract recognized in accordance with IFRS 16, which is lease liability. So all these examples are speaking to the categories of example that we can capitalize, the category of example that meets up the capitalization threshold in line with IAS 23. Also, we have some key examples of qualifying assets. What do you mean by qualifying assets? I define qualifying assets as a type of asset that take a substantial time before they can be completed for their intended use. So what are the examples of qualifying assets? Qualifying assets. We have the inventories that require a substantial period of time to bring them to a sellable condition. We have different type of inventory. So what they are talking about here, these are the inventories that take a substantial time before they can be completed, and they can be ready for sales to our consumers. We also have manufacturing plants. Manufacturing plants, for us, for a company that deal with that kind of production, it's going to take them a very lengthy period of time before they can be ready for their intended use or sales. We also have power generation facilities. We have intangible assets. We have investment property, and we also have barrier plants. This barrier plant is also an accounting standard I'll be looking at under IAS 41. The investment property is also under IAS 40. The intangible assets is also there. So all these are examples of qualifying assets. So just like we have the example of qualifying assets, we also have some example of assets that may look like qualifying assets, but in real sense, they are not qualifying assets. So what are the examples that fall under these categories? We have the financial assets. We have inventories that are manufactured or otherwise produced over a short period of time. I think what we need to understand here is the time of production process. Yes, substantial time is being used for us to be able to identify, to have a clarity around what are the type of asset that actually meet up. Okay, so people from YouTube say they can't see the. Let me increase the font. Sorry about that. Let me increase the font so that. Thank you very much for reaching out. I think it should be visible enough now. So let's move on. So example of assets that are not qualifying assets. So we have the financial assets, we have inventory that are manufactured within a short period of time. We also have asset that is ready for the intended use or sale when purchased. So basically what we need to understand here is that we are talking about borrowing costs, which are the extra costs that we incur on the fund that we borrow from the financial houses for production of a particular organization project. Now, what are the type of costs that we can capitalize, and on which asset can we now claim, okay, on this particular asset, I've incurred a borrowing cost that I can capitalize? So they are not trying to let us understand the categories of assets that cannot be a qualifying asset, we have more than 3 examples, just like only 3 examples that I have here. We have a lot of them in laws, like there are a lot of the examples that does not meet up with the does not meet up with calling them a qualifying asset. And all of the clear difference between qualifying asset and non-qualifying asset is the substantial period, is the timing process that it takes the organization before they can get them ready for the intended use. So moving on, we'll be looking at treatment of borrowing costs, suspension of capitalization of borrowing costs, cessation of capitalization, that is when should we stop capitalizing particular borrowing costs. Also, investment income earned on temporary available surplus fund. We also have borrowing costs or interest before commencement of construction, and we'll be looking at investment income or interest earned before commencement of construction as well, and the capitalization rate to be used. So we're talking about a qualifying asset constructed in stages. So when a qualifying asset is constructed in stages such that each stage or part can be used or sold individually, while construction of the remaining development continue, the capitalization borrowing costs relating to parts substantially completed should cease or stop. What do they mean by this? Just like we define qualifying assets to be an asset that takes a substantial time before their completion. However, if a particular qualifying asset is a type of asset that it has different stages. there are different stages to it. Let's say, for example, building a 5 different duplex, five different duplex on a specific land. Now, for that type of qualifying assets, the moment we completed one section of those 5 duplex, the borrowing costs that belong to that particular first section that we have completed, we are going to stop it. Not that, okay, because we have not completed the whole 5, we continue to capitalize every borrowing cost incurred on everything. No. So far, we have been able to complete one section. That section that we have completed, the borrowing cost belonging to that particular portion will be stopped. That is what they are trying to let us understand here, that for an asset that have different stages, in which these stages can be used separately. As we complete the stage, it's already being used, or it can be used like that without depending on the completion of others. And that's why I cited an example of having 5 different duplex being constructed at a time. Once we complete one particular duplex, the borrowing cost that is being attached to that particular duplex will be ceased or stopped, because we have completed that particular project, and at that stage, that particular project can be used like that. So the borrowing cost belonging to that will be stopped. While we are going to continue the borrowing cost for the remaining 4 sections. So while we continue to look at the borrowing cost for the remaining 4 sections, and we stop the one that belongs to the one that we have completed. So let's look at the recognition of borrowing costs. Borrowing costs should be recognized on all funds, whether the borrowed funds were used on the qualifying asset or not. So this will be better explained. Where we solve an example on that, it will be better explained. But let me just try and explain it. What do we mean by this is that, you can borrow a fund, and part of this fund, we are going to use it for different projects. We are going to use it for different projects. So what we are trying to establish here is that the interest cost should be recognized on all fund borrowed, whether the borrowed fund were used on a qualifying asset or not. So far the fund is being borrowed, whether you use it for a qualifying asset or not, you should recognize the interest cost under them, or the interest cost that's being attached to this particular fund. It's not left to you to now determine which one are you going to capitalize, which one are you not going to capitalize. Let's say, for example, an organization that borrowed 10 million naira. A part of this 10 million, only 5 million is being used on the qualifying asset. It means that we are going to recognize the finance cost that is being attached to the total 10 million. However, for the 5 million that meet up with the qualifying assets, that means only the portion of the borrowing cost that is being incurred on that 5 million that we are going to capitalize. While the borrowing cost belonging to the remaining 5 million will be expense, but you need to recognize it. You need to recognize this. You need to recognize the total borrowing cost that is being attached to the 10 million in general. So measurement of borrowing cost to be capitalized. The amount of borrowing cost to be capitalized should be measured at the amount of borrowing cost. Sorry. I think I was being rushed when preparing these notes. Sorry, please. So the amount of borrowing cost to be capitalized should be measured at the amount of borrowing or interest cost incurred or the borrowed fund or loan used on the construction or acquisition of a qualifying asset. This is what I just explained now, that irrespective of the amount or the total value of the money that we borrowed, only the one spent on qualifying assets should be capitalized. Only the one spent on qualifying assets should be capitalized, while the rest that does not meet up with the capitalization threshold should be expense. So also we have qualifying assets finance from existing loan, or that is pool of funds. So this is a situation whereby the company has its loan from different source, not for a specific source that is being directly attributable to the particular project. You have the borrowing from different angles, and part of this fund that you borrow from company A, company B, company C, you are using it to finance your qualifying asset. So in this situation, what is going to be our finance cost rate is going to be the weighted average cost of all the borrowing sources. What do they mean by weighted average cost? What I mean by weighted average cost is that so far you have different sources of financing with different rates be attached to them. You borrow from company A at the rate of 5%, company B at the rate of 5%, at the rate of 10%, company C at the rate of 15%. So this is now becoming a pool of funds that you are now using to finance a particular project. So what they are saying here is that for you to know the actual rate you are going to use in calculating your interest that you are going to pay on this fund, you should find the WACC of the pool of funds, which is the weighted average rate of the pool of funds. So doing so, we are going to arrive at a single rate that we can use to calculate our interest. When we solve an example, we are going to understand this better. It is talking about qualifying assets. We have discussed this already. So disclosure. The following should be disclosed in financial statement in relation to borrowing costs. Number one, the amount of borrowing costs capitalized during the period, the capitalization rate used to determine the amount of borrowing costs eligible for capitalization. Number three is the accounting policy adopted on the exchange differences on foreign currency borrowing. So I think we now have more than enough questions. Sorry. Yes. But we will have some past questions here. Can we finish all this question? Okay, let me allow you to ask any question before we start solving. I'm sorry, I don't know, I'm very fast. Please, I'm sorry. I'm just looking at the time. I'm very sorry, ma, please. So, please, do we have any question before we start solving questions?
Yes, sir. Please, sir, can
Yes,
you
sir, we
go
have
through the
questions.
disclosures?
Okay. So let's take our question one by one. Mrs. Esther John, you can go for it.
Please, I want you to go through the disclosures again so we can get the main point. It was so fast, so we need to get to the main point.
Okay. Sorry about that. So this disclosure is talking about what we need to disclose in our financial statements relating to the borrowing cost. What are the things that is expected from us to disclose in our financial statement? We are talking about the borrowing cost. Number one is the amount of borrowing cost capitalized during the period, which is the total interest that meets up the capitalization threshold. That is the total interest that is being spent on the qualifying assets. That is what I mean by the amount of borrowing cost capitalized during the period. Number two is the capitalization rate. That is the rate we use in determining our interest. Is it a pool of fund? Is it a specific fund? So It's possible that an organization borrows specifically for a particular project. Maybe I want to build a house now, like move on to any of the financial houses, borrow me 10 million, and then give me this 10 million will be charged 10% interest rate. I borrow that 10 million specifically for that project alone. That one is very straightforward. My interest rate is going to be 10%. There's no doubt about that. But in a situation whereby I borrow from different finance houses to finance a particular project, all these houses will be having different rates. So if that is the situation, we are going to look for the weighted average rate of all the sources of borrowing. So I'm going to show us how to get our weighted average rate. So we are going to multiply them by the total fund. So from there, we will get our finance cost. Then number 3 is the accounting policy adopted on exchange difference. So another thing, sorry, I need to add to it is that period-wise, just like I said that a qualifying asset, these are the assets that take a substantial period before they can be completed for their intended use. During this period, a lot of things can happen. So based on what happened, there are some scenarios that we need to stop capitalizing, while there are some scenarios that we can't stop capitalizing. So I'm talking about the suspension of capitalization of borrowing costs. So I will add it to my notes. It's not on this soft copy. I'm going to add it to it before I send it to the class. But let me just brush through it so that we can understand. So in a situation whereby there's a delay, there's a temporary delay during this substantial time. So if there is a delay, we need to know what caused this delay. Is it as a result of what is being required from us before we can complete the actual project? What do I mean by this? What I mean by this is for those of us that have experience in construction company. So, before you can build a house and get it ready, there is a stage that you need to wait that the concrete and all those plastering, this thing, before they can be, they need to dry, or they need to, I don't know what to use for them, but I think there is a stage that you need to wait. You can't just complete an house and finish it a day without you waiting for some period, so that all the cement and the production process, they can actually stand very strong. During a period like this, that it's now becoming a necessity for you to wait. So during this period, you are still going to continue your capitalization process. However, on the other hand, if the delay is as a result of the company negligence or a personal wish from the company or from the management of the company, okay, let's just wait. Maybe they want to exploit the capitalization process. For that period that you wait as a result of your own personal reasoning that has nothing to do with the process of completion, for that period that you wait, you are not going to capitalize the interest rates that you are going to incur for those periods. You are not going to capitalize it as part of the value of the asset. You are going to expense any interest rates that you incur in this period. I'm going to add this to our notes so that it's not here on this note. I just remember now. I'm going to add it to our notes. So I just feel like I should just take my time to explain it better to us. So have I answered your question on the disclosure requirement?
Yes, sir.
All right. So, sorry. Mr. Dauda. Sorry, Mr. Dauda. Sorry, I don't. Okay, are you there?
Yes, I'm here.
All right.
Good evening, sir.
Good evening.
So you explained borrowing costs. You said because of an asset, the cost of an asset can either be expensed or capitalized. And then you went ahead to say that we have examples of borrowing costs and you give examples of qualifying assets. My question is, under both of these examples, that is for the borrowing cost and qualifying expenditure, how how do we ascertain which to expense and which to capitalize? I just want to understand how a particular item can be expensed. Like, how do we trace an item that can be expensed and which should be capitalized? That's my question.
All right. Thank you very much for that. So basically, when I was explaining the meaning of borrowing costs, I said these are the interest or other costs incurred by an entity in connection with the borrowed fund. In a simple term, when we say borrowing costs, we are talking about interest that is being attached to a particular fund that we borrowed. Now, in line with IAS 23, which talk about the borrowing cost, there are some type of asset that we call qualifying assets. And we define qualifying assets as those assets that take a substantial time before they can be completed for their intended use. So, for this type of asset that take a substantial time before they can be completed for their intended use, I will give an example of it. We mentioned investment property, we mentioned lease agreements, we mentioned bearer plant, IAS 41. You see, all this type of property that an organization decided to embark on or decided to acquire them by borrowing fund from any source, from maybe the financial houses or bank. So for this particular fund that an organization borrowed to incur all these examples of qualifying assets, let me take that again. For fund that organization borrowed on acquiring qualifying assets, the interest you are going to pay on this fund should be capitalized. What does that mean by should be capitalized? It means that in your own book, when you want to determine the value of the asset, let me set an example. Maybe you want to buy a house now. We have assumed that that house has met up with the definition of qualifying assets. In your own book, you need money to finance that project. Now you need 20 million. You approach UBA, give me 20 million. My organization want to acquire this particular asset, or you want to build it, 20 million. UBA now told you that, okay, for this 20 million we are giving you, you are going to pay an interest rate of 5 million. You are all together, you are going to pay 25 million, which means that the actual fund you borrow is 20 million. The interest on it is 5 million. Now, let me now come down to your question. What should we capitalize? What should we expense? Now, we define qualifying assets as assets that take a substantial time. I will now say that, okay, these assets that take a substantial time, for any interest you incur in acquiring them, you can capitalize it. What do you mean by that? 20 million you borrow to acquire or to build that house for your organization. You are now going to pay 5 million interest on it. So far, you are going to spend all the 20 million on that asset. The interest you are going to pay on that 20 million, which is 5 million. What we mean by capitalization is that in your own financial statement, if you want to present the value of that house, you have the right to say, okay, the value of the house is 25 million. Okay. Because the 5 million you actually pay extra is as a result of the qualifying asset that you use the money for. Now, let me use that example again to explain some part of this, of the standard. When we say, in a situation where you borrow that 20 million and you only use 15 million for that particular asset. Now, the total interest on that 20 million is 5 million. What we are going to do now, we are going to apportion that interest of 5 million. We need to know what belongs to that 15 million and what we are going to apportion to the remaining 10 million. If you spend the remaining 10 million on another project that does not meet up a qualifying asset, the interest that belongs to that 10 million, you are not going to capitalize it. You are going to expense it. What we mean by expense is that instead of you adding it, let's say now, okay, that 15 million, the interest portion that belongs to you is 3 million. The remaining 10 million, the interest portion that belongs to you is 2 million. Now, you have agreed with me that 15 million plus the 3 million making 18 million. That is the value we are going to recognize in our financial statement because it has been solved with the qualifying asset. Now, which will be the 10 million here that you spent on another thing, which does not meet up the categorization of qualifying assets. That 2 million expense you are paying on that one, you will not add it to that 10 million. You are going to expense it in your P&L.
All right.
However, it's possible that you are embarking on more than a single qualifying asset. Maybe one is 15 million, another one is 10 million. You are going to capitalize the interest that belongs to both assets. I hope you will get my explanation.
Very clearly, sir.
All right, thank you very much.
Thank you very much, sir.
Mr. Michael.
Good evening. Good evening. I followed through with the explanation you were giving to the man that just asked question now. You said that 2 million. What are we going to do to the 2 million? Sorry, I didn't get that part. You said we are going to do what to the 2 million naira? I understand we are going to add the 2 million naira.
What do you say?
Should I continue?
Yeah, continue.
I understand that we are going to add the 5 million naira to our costs. That 2 million, you mentioned 2 million naira. What are we going to do with that 2 million?
Okay, so what I was trying to establish is that what are we using the fund that we borrow? What are we using it for? Are we spending it on a qualifying asset? If you are spending it on a qualifying asset, it means that for every interest we incur on that fund that we spend on the qualifying asset, we can capitalize it. What is the meaning of capitalizing? The meaning of capitalizing in a simple term is that we are going to add that interest to the total fund that we borrow, to the actual fund that we borrow for that particular project. If we borrow 20 million and we have to pay interest of 5 million, we are going to add that 5 million to 20 million, making it 25 million. So that 25 million will now be the value of our assets. Now, when I was explaining to Mr. Dauda, and I set an example of, okay, out of the 20 million that he borrowed to finance a qualifying asset, he only used 15 million for that particular qualifying asset. He only spent 15 million for that particular qualifying asset, while the remaining 10 million was spent on another thing that does not meet up with the word qualifying asset, which are the assets that take a substantial time before their completion. I hope you are with me. That 10 million is not used on qualifying asset. The 10 million is used on another thing. And I'll say that, okay, the total interest on 25 million is 5 million. Now, you are not going to recognize the 5 million on that 15 million alone. So far, the 5 million belongs to the 20 million. You get? We are going to, just like you split the money, we are going to split the interest charges at 2. Now, we are now set an example, okay, out of the 5 million, 3 million is for the 15 million, while the remaining 2 million is for the remaining fund, which is the remaining 5 million. Yeah. I was now explaining to you that 2 million interest does not meet up with the capitalization threshold. You cannot capitalize that 2 million, which means that you cannot add that 2 million to the remaining 5 million and claim that, okay, this another asset is 7 million. Unless that particular 5 million that you set as spending asset capitalization. What I was explaining to him in a simple term is that only the funds spent on qualifying assets, only the interest spent on qualifying assets can be capitalized. The rest will be expense.
Thank you, sir. Yes, thank you, sir.
All right. So, do you still have any other question? Okay.
So
For those
continue.
that join us, all right. For those that join us on YouTube, sorry I could not check if you have questions. I'm very sorry about that. So let's just try and solve at least one question tonight. So I hope you can still see my screen.
Yes, sir.
Yes.
Okay, so this question, there are some of the questions that the answer is here already, but I still want us to solve one that. See this last question, the answer is there. Let me look at the past question that I have here. Okay, I think this is a past question.
Me, I cannot see
This is a past question. Okay. Can anybody confirm if they can see my screen?
So I can see
Yes,
yours.
I can see it. I can see it.
Yes, I can see it.
Okay. Maybe that is a service issue from your end. Just hold on, you will see it. Maybe it's a service issue from your end. So I'm going to solve this question 5. I'm going to solve this question 5. So let's go through this question. In accordance with IAS 23, borrowing costs that are directly attributable to the acquisition, construction or production of a qualifying asset form part of the cost of that asset, while other borrowing costs are recognized as an expense. Required. State the condition where in capitalization of borrowing costs commenced. When should the capitalization of borrowing costs commence? When should it be suspended? And when should it be ceased? I think we have discussed all this now. When can they commence the capitalization of borrowing costs? Is there anyone that want to answer that?
Good evening, sir.
Good evening.
Yes, I feel commencement should be immediately, as soon as possible.
Thank you very much for that. Thank you very much. So commencement of capitalization should be immediately the fund is available for use. Immediately the fund has been released to us, the capitalization process should start. Then we have, when should it be suspended?
When significant development is interrupted or stopped.
Thank you very much for that. Thank you very much. So, not to waste our time, let me just take us through the answers. So, when an organization or an entity has incurred an expenditure on the asset, when an organization or an entity has incurred expenditure on the asset, what do they mean by incurred expenditure on the asset? You want to start the construction and you have got the fund has been made available to you by the financial houses, and you have incurred any expenses on it, then you have the right to start capitalizing. You cannot start capitalizing when you have not incurred any cost. Immediately you incur a cost on it, you can start capitalizing. So let me put that.
commence it. Post. Okay, post. Hello, mommy. Can you tell your posting on the phone here? So, I'm not doing that. That's me.
Absolutely, Bryce.
So, please,
Yes, I'm not saying anything yet. I'm trying to. Sorry. Okay. So I'm thinking of we should solve the calculation part. Why this written aspect will be sent to the group chat together with the calculation part so that we can save our time. I don't know if that is okay by us. Okay. So let's move to the calculation part. Again, please. If I can see is construction factory that will take about 18 months to complete. First remains. Sorry, please, I'm trying to look at the question again. Maybe something we can complete. Thank you. Sorry, what I'm looking at is, you see this particular question, it's a question that we are going to calculate the weighted average cost of capital. So I don't know if it would be nice to start solving with a question like this, or we should solve with a question that is a bit simple like this than this, to avoid a lot of questions that will be coming up. Then after that, I'll try this and I will send you the solution. Because I can remember this, we need to calculate the weighted average of all these funds we have here. This 160, 240, 1.8. Then also the bank overdraft. Let me allow you to decide. That's so should we just solve these, or we should solve another one that is a bit simple like this?
So I can
Sir,
solve
please
the
let's
easy
solve
one.
with it
Let's
now.
try it.
Yes, I feel we should solve this.
All right. No problem.
That's nice.
Solve the
Please.
complicated one.
Okay, so let's go through the question together. So Fightamax PLC is constructed. So I decided not to mute all of us so that in case we have any question, we can just ask. Please don't let us abuse it, and let's mute our mic if we are not saying anything, please. So Fightamax PLC is constructing a factory that will take about 18 months to complete. The company commenced construction on 2nd January 2013. The following payments were made during the year. January, 40 million, 31st March, 90 million, 20 June, so all those there. So the first payment on 31st January was funded from company pool of debt. Let's take note of something. What we have here from 31st of January to this 30 December, these are how the company incur.
Sorry, say your screen.
What do you say? You cannot see my screen.
We can see your screen, sir. Continue.
We can see. Check your network.
I think it's your network. Maybe you need to refresh. I don't want to say you should log out, or if you log out, someone else will come.
Sir,
Maybe
please just mute everybody. Just mute all of us.
Okay. So let's continue now. So all these funds you see here, from the 40 million to 50 million, these are the instrumental expense, like instrumental procurement on the particular project. On 31st of January, the company incurred 40 million. On 31st of March, they incurred another 19 million. 30th of June, 20 million. 31st of October, 40 million. 30 November, 50 million. Now, they are now explaining to us the sources of each of these funds. The first payment on 31st January was funded from company pool of debt. However, the company succeeded in raising medium-term loan notes for an amount of 160 million on 31st of March 2013 at a simple interest rate of 9% per year, calculated and payable monthly in arrears. These funds were specifically used for the construction. Excess funds were temporarily invested at 6% monthly in arrears and payable in cash. The pool of debts were again used for a 40 million payment on 30 November 2013, which could not be funded from the medium-term note. The construction project was temporarily halted for 3 weeks in May 2013 when substantial technical and administrative work was carried out. The following amount of debt were outstanding at the reporting days of 31st December 2013. Medium notes, back of the overdraft, 10% 7-year notes. So for the back overdraft, the weighted average amount outstanding during the year was 150 million, and the total interest charge by the bank amounted to 6,760,000 for the year. Require calculate the total amount of interest to be capitalized. All working should be to the nearest 1,000 naira. So don't worry, I will send the question to the class. But let's just solve it together. Let's pay attention. And if you have any question, in fact, let me monitor everyone. I'm going to solve it. Once I finish, if you now have any question, because if I say you should be asking questions as I'm solving, you may not be able to finish it. So let me mute everyone now. I'm going to solve it. And if you have any question, you ask. So if you can remember when I was explaining how to get our WAG from the note, I said we are going to get the total fund that we borrowed against the total interest that belongs to each sources of fund. We are going to add everything together, then divide it before we can get our weighted average cost of capital. Now let's go. Let's first of all calculate our WAG. So this class is getting longer than you should expect it. But that is not a problem. So we're going to say total interest. Total interest plus bank overdraft divided by fund. So what is our total interest? Total interest rate. Sorry, trying to let me put this so I can see the question side by side. Sorry, I want to make sure that the Excel is doing the calculation for us. Okay? No. Yeah. We are giving this directly from the question to be 6,760,123. So it's equal to this power this plus sorry, I'm a bit slow using this. I don't expect it to be like this. Well, don't worry. We all get it clearly once we start explanation. So see question again. $40 plus 90 plus 20 plus 40 That's 15. Take 24 80. Yeah, Treasury. Yes, they have. This is actually in billion. This 1.8 is in billion. So it's in billion, not 1, 2, 3. 20 million. Okay. Okay. Then we have the Tutor fund. Tutor fund. We have the Tutor fund. So this is just the only working. The rest are very straightforward. So we need to get this working. Sorry, I'm taking much of your time. Tutor fund. Okay, the second part now is Tutor fund. Yes. Just Tutor fund. Yes. $80 billion. Then bank overdraft. Bank overdraft is how much? Bank overdraft is 150 million. If I'm not mistaken. Bank overdraft is 150 million. Yes, 150 million. And is the interest rate. So going to our formula, which says that total interest plus bank overdraft rate, which is this, divided by total fund plus bank overdraft. So simply means what we are trying to calculate here is the interest portion that we are going to pay on this 1.8 billion plus the interest portion we are going to pay on the bank overdraft divided by the total fund, which is that actual 1.8 plus the total fund from the bank overdraft. This is what we are trying to do here. So here we get our weighted average cost of capital multiplied by 100. There's multiplied by 100 there. So our is it here? So equal to this divided by this times so these are weighted average cost of capital, and this is what we are going to use as our rate for those funds that will withdraw from the pool of fund. For every fund that will withdraw from the pool of fund, this is the rate we are going to use to calculate the interest. Now let's analyze the fund we borrowed now. I feel like I should let you on mode to ask question, but I'm scared of the amount of questions that may come in, but let me just finish it. Please stay with me. Sorry, I'm taking much of your time. I'm very sorry. I'm just looking at the best possible way to explain this to us. I'm very sorry about that. So the next class will not be like this. So our first drawing is what? Is on the our first drawing is on 31st of March, 40 million. And if you come here, the first payment on 31st of March was funded from the company pool of debt. But let me solve it so that I will save myself from this. First drawing, the first. Okay, all right. Now, go to 40, 1, 2, 3, 1, 2, 3, times this. What I want to do is that I want to show my working. I want to show how we get this. Basically, what we do is 40. Okay, I think it makes sense like this. Now, second drawing, Second one is 90. 90. Indicate something. Is me pool of fund. Let me even write it. So the sources of our fund will determine the interest rates we are using. This is for specific fund. Equal to so can we still continue? You can unmute, please. So
Yes, please, you can continue.
Yes.
Okay,
Yes, sir.
okay, please. I don't want
Yes,
to be there
please
anymore.
continue.
Okay, so I'm
Yes,
sure
sir,
this
if
is
it's
taking
possible,
much.
just round up the question, the survey.
All right. So I'm sorry this is taking much of our time.
Please,
It's as a result
sir,
of
please,
what do you say?
can you share the question in the group? Can you share the question in the group?
Definitely, I will do that. I will share the question with the group. I will share the question.
So how are you going to do about the explanation? Because I'm just
You are sleeping.
no, I said explanation.
Yes, I want to solve it so that I can use the solution to explain. Or should we be solving it together?
No, sir,
No,
continue.
solve it, sir, because it will take time. Solve it, then after that we'll explain.
Please
Okay.
continue. Please.
Together will be better.
So our third drawing, fourth, and fifth, they are all from specific font. So what is our third drawing? Our third drawing is 20. The fourth is 40, and the fifth is I think the mistake I made is that we should have just come another next week to solve the question specifically. But I still have more than one question. I think that's what we're going to do. We're going to solve this one only. Then our next class, we solve the remaining one. I think that would make sense like that. Okay. The fifth drawing is how much? 20, 40, 50. Okay. So it's only 10 that remains here. So it's 10. Okay. All right. Uh, this is the end of the question, but let me. I think I've taken most of our time tonight. So we have two options. Is that I continue to explain this now, which I believe most of us are not online again, or we should postpone everything to next class. So I'm going to solve two or three questions, like two or three questions in addition to this. And next class, we are going to look at everything together. That is my own suggestion.
Yes,
However,
sir. Yes. Yes.
A good idea.
Please.
so I think that would be better. So
Yes.
I'm going to solve two or like let me say I'm going to solve additional two questions to this. So when we come next week Monday, so we are going to look at it together. So that next week Monday we are going to finish our IAS 23. Is that welcome by everyone?
Yes, sir.
Yes, sir. Thank you, sir.
All right. So I'm very sorry for taking this much of our time. I'm very, very sorry. I don't know it's going to take this long. So in my own brain, I was thinking maybe it's something we can just run through because I don't even have plan of using the Excel to solve them before. But I think that would be the better way for us. So I'm very sorry for taking much of our time. So okay. I will share the material to the group tonight. I will share the material to the group. The question will be there too. However, I'm not going to send the solution yet until I finish everything. So, are we okay with it like that?
You can send the
Yes,
solution
sir.
so I
Yes,
will be
sir.
looking at it now. Like this one you dropped this night, this solution you did this night. You can send this so I will be looking at it.
All right, no problem. But don't worry.
Yes.
I will send the material. The one we used tonight, I will send it.
So please, can you explain small?
What's the
He said next class.
is it the solution?
There's no need, please.
Next class, so
Explain to me. Are you not going to drop this tomorrow? Please, oh. Thank you, sir. Next class. Drop the
All
material
right.
and let us look at it.
All right, no problem. So we are going to explain everything next class. I will solve two standard questions that they have asked in study pack, like past question. I'm going to solve two in addition to this. This one too is also a past question on its own. So I'm going to solve additional two to it to this one, make it three. And we are going to look at like extra two that their own solution is even on the question already. So we are going to look at it together. The mistake is that I should not have picked this question first. I should have picked the literally two one that is very straightforward. Not this one should have been the last one we are going to solve. But no problem. So I'm very sorry for taking much of your time. I'm very, very sorry. Please. I'm very sorry.
No problem.
Thank you, sir. Good night, sir.
Thank you very
All right, no
much.
problem. Good night.
Good night.
Almost.
Good night,
Thank
sir.
you, sir.
Thank you, sir.
Good night.